From Barangaroo Studios, this is the COB, brought to you by eToro. Invest in ASX shares with $0 commission.
Good afternoon. Welcome to the COB, the stuff you need to know in the day in business and markets. I'm Kyle Rodder, of course, here once again with Danny Ikuye. Danny, well, we've broken our hot streak down very slightly for the day. And as you can see there, market off by, well, it looks like it'll be a decline of about 0.4%, all things said and done.
Yeah, I think we can thank those in unemployment numbers, or employment numbers, I should say, and that leads us to the three themes,
It does. And those, I think that is probably the news of the day, really, isn't it? It's that we had those jobs figures out in Australia, and well, a lot stronger than expected. Here we are, jobs, 3.5% the unemployment rate, 53,000 jobs added to the economy. I mean, it's not exactly getting any worse in terms of, I suppose, the situation for the RBA trying to take a little bit of steam out of the economy, but it's certainly not getting any better yet. There was the expectation that maybe we'd see a tick up in the unemployment rate.
Yeah, I think that the numbers are so hard to interpret because a lot of companies really wanted to hire people because we had such a shortage, you know, as a result of COVID. And it's just interesting because I've come across two anecdotal examples of young people looking for casual work, and they actually can't get it in pubs and Woolworths. And so maybe there was a rush to employ everybody in March, and because we've had so many people now come into the country, all those jobs have been filled. I think it'll be really interesting to see what happens in April. So I'm more in the camp that it's very much a lagging indicator. We've had a bit of a banking crisis overseas and confidence, and yeah, it's very challenging for the RBA because they're constantly watching the data to work out where they go, and they're walking that tightrope between Australia's indebtedness that households have versus wanting to get inflation and inflationary expectations down. So yeah, we'll continue to invest or trade as the data comes in.
Absolutely. And I did have a really good chat with Phil O'Donoghue from Deutsche Bank, almost touching on that little topic there, where the RBA, at least compared to some other central banks around the world, is trying to keep things on an even keel. That's the language that they use. But, you know, sometimes an even keel is a really hard thing to manage. If you need to take steam out of the economy, sometimes you need to whack the labour market, almost do what the RBNZ has done and just really continue to hike. But as you alluded to too, this data can be a little bit lagging. The RBA has pointed to the long and variable lags of monetary policy as it's so often quoted. So maybe well, these numbers don't really sum up the picture just yet. We will have to wait and watch. But moving on, and that maybe might be a good segue because a word that was being thrown around in the States last night was recession.
Absolutely.
Again, the R word.
Absolutely. And it was really interesting to see the FOMC, the economists, coming out and saying, when we saw those meeting minutes, that they're actually telling the board members that post the SVB collapse and all the problems in the banking sector, probably a tightening of credit conditions, and also too that the US would probably go into a mild recession. So some people would say that's somewhere between a soft landing and a bit of a slowdown. I think they downgraded GDP growth to 0.4%, okay, for this year for the US. And it's interesting because it's much easier, isn't it, strategically, for the economists in the FOMC to say to the board members, oh look, there might be a recession, as opposed to Jay Powell and all the other members coming out and saying, well look, we had to smash the economy to get rid of inflation, and by the way, you're all going to end up in a recession. So I actually thought that was quite convenient for them, for somebody else. Oh look, it was the banking crisis, not us, but arguably it was the banking crisis that they caused. So I think, you know, the markets now will probably start to at least think about economic recessions in the US. And as you well know, Kyle, there's this big split between equity markets in denial or bond markets saying we've got a big recession.
Absolutely.
And we might learn more from the third talking point that you wanted to touch on, which is coming up.
Exactly. We're 48 hours, we'll call it, away from the bank results kicking Wall Street's earnings season off. So we'll get a lot of colour around the economic outlook, around what earnings could do for some of those major Wall Street firms. And again, they might use, I suppose, that R word. Never waste a good crisis, I suppose. And that's what you were saying there about central bankers. But let's just crisscross a couple of sectors of our market very quickly, just to see which areas outperformed and, well, which didn't. Starting with the retailers, an interesting day for them. And I mean, it's hard not to feel that maybe some of these rate expectations, which at the margins probably lifted in terms of the likelihood of an RBA hike in May. Again, only at the margins, may have weighed on the retailers just a little bit today. They were the worst, or the consumer staples and the consumer discretionary stocks were amongst the worst performers for today.
Coles, when I looked earlier, was actually hit quite hard, and I assume that's because, I don't know, because Wesfarmers sold out their last 2.8% stake. It really didn't make a lot of sense, but then sometimes markets don't make sense. But you would have thought with a tighter labour market that possibly you are looking at another interest rate rise. But the star sector was energy. Yeah,
it was. And well, actually, you brought my attention to it today. It was potentially, and correct me if I'm wrong, the US potentially refilling those strategic petroleum reserves, offering a little bit of a bid, another I suppose floor under the price. We've got OPEC helping out, and well, any time the prices get low enough, the US tries to obviously load up when it comes to their strategic reserves.
Yeah, so overnight the US Energy Secretary Jennifer Granholm basically said that the federal government would begin buying oil to replenish that emergency stockpile later in the year if it is advantageous to taxpayers. So of course, you know, the oil markets jumped on this as a signal that you would have a large buyer back in the market, which really underpinned the oil price rise there again. Yeah,
now energy players benefiting. Woodside, the punter's favourite when it comes to try and trading the oil price as far as an equity market proxy on the ASX, up by around 1% and $34.50 per share. I think we've got to look at big tech very quickly as well, or local tech, I should say. Let's see if we've got that graphic there too. No, unfortunately, that's not doing what it's supposed to. But nevertheless, tech stocks were marginally higher today. So a bit of a hodgepodge, it has to be said. But we should get to the corporate news now, because top global miner BHP has secured the backing of Oz Minerals shareholders for its $9.6 billion buyout at a vote today. The deal was unanimously recommended by Oz Minerals board and has already passed several regulatory hurdles. The copper gold producer on December 22nd last year entered a scheme implementation deed with BHP to proceed with the takeover.
Yeah, and then just briefly touching on Wesfarmers, as I stated before, they've sold their remaining 2.8% stake in the supermarket chain Coles Group. There was no official disclosure of the price at which the stake was sold, but it has been reported that the deal was worth around $688 million or $18.50 per share. And both the companies will continue their customer loyalty program Flybys, retaining a 50% interest each in the joint venture.
And in perhaps the big corporate news of the day, perhaps at least the most positive anyway, is Australia's corporate travel management rallied on news of a contract with the UK Home Office. The business travel solutions provider said the estimated transaction value stands at about $3 billion. The contract works includes services and logistics support. And Danny, it was the stock of the day today. So have a listen to what our guest had to say about corporate travel management.
There could be some catalysts coming up to get the share price going with, China reopening and so on. Obviously, today's announcement is a great one. As a technical trader, we're looking at $19 as a key level it needed to get above to confirm that the downtrend is over, and it's clearly done that well and truly today. So, I mean, at first glance, I'd say this is good news. Obviously, the North American business, we'd like to see that one improve, but this is a big increase to earnings, and I think potentially this is an opportunity to get a bit more upside in the share price.
North American business has underperformed the rest of the business. I go with a hold, just with consensus in line with a lot of expectation, and Citi's gone with a hold, just because the company overstaffed during the pandemic in preparation for the travel rebound in the US, which obviously naturally failed the business, as we've seen the North American operations coming or underperforming. So I think at the moment, and also we know travel demand peaked to its highest level ever recently, and all of the other companies like Qantas, all of the airlines, they outperformed the market, and this one failed to do so.
That was Grady Wolf there from Bell Direct, Michael Gable from Fairmont Equities, and corporate travel management. I always like to ask you, of course, because I suppose if there's anyone at this desk anyway that's going to be better at picking stocks, it's going to be yourself, Danny. Do you have a view on corporate travel management? Ever sort of stoked your interest by any chance?
Yes, I have held it once upon a time.
You like it?
I struggle with some stocks because I don't, I do well and then I don't do well. I must admit I'm not big into travel stocks. That's just me personally.
Yeah.
But I would say for the company, this is a great contract. That's the type of contracts you want because they're reliable, they're secure, they're coming from a government, and it's a reliable earnings stream. So, just as a casual observer, it would look like there was a reason for the share price to be up that much today.
Yeah, everyone wants to jump on the government gravy train quite naturally, and I suppose with the travel sector, isn't it? It was a good thematic play there for a couple of years if you wanted to sort of, I guess, play a COVID reopening story or whatever. Again, for me, I don't steer clear, but my opinion's worth about that much. Anyway, let's talk recession and the R word once again, because your view today was talking exactly about that.
Gosh, that seems like an eternity ago. Yes, I was. I was basically just covering that the recession is being talked about again, and again, it's this I suppose the pull me push you between the equity market and the bond market, and clearly both of them can't be right, and that's what's perplexing for investors at the moment. Which tack should we actually take? And I just cited some research from Morgan Stanley about what happens when you have bond markets indicating 160 basis point cut in rates in the US, and what typically happens to share markets. So you'll have to read that one to see what Morgan Stanley had to say.
Yeah, absolutely. And I suppose it is that fascinating dynamic, right? Because we've spoken about it with several guests, you and I, over the last few weeks, where at least some parts of the equity market seem to be in that kind of 2010s style of thinking. Is this, well, if it means rate cuts, well, we just go and buy big tech and all these other names. Happy days, it's good for equities, but it might not be the case anymore. No,
I think there's a lot of muscle memory, particularly from 2020. When the Federal Reserve came in and pumped huge amounts, $3 trillion worth of liquidity into the system. And, that was a systemic collapse in the system. It was, the liquidity had dried up, so it had to come in, and so you could go in and buy all these stocks. People have sort of forgotten that if rates are dropping, that's not good. That basically is suggesting that something is actually wrong. And that is really what some of the major economists and also a lot of fund managers talking about it. Are we going into an earnings recession? And that is why the US earnings reporting season is going to be so important in terms of giving us an indication of not only what's been happening in the March quarter, but what the outlook is, if they give an outlook or not, and what's happening with margins.
Yeah, and you cited it yesterday, the FactSet numbers suggesting that we could get a contraction of about 6% in earnings this quarter.
I think that's what S&P are looking at, about 6.8%, and that's off the back of around 1.2% for the December quarter.
Yeah.
But typically in recessions, not that anyone wants to hear this, but earnings can contract by 20%. It won't be across the board, but the markets have very much been positioning themselves in certain stocks, defensive quality stocks, and I think the market is selectively weeding out places where they think that they can hide out in. And it's quite pronounced in the US and also to a certain degree here in Australia.
Yeah, well, let's get in our guest now. Perhaps he can provide a view on that. Henry Jennings from Marcus today. Henry, our themes of the day have been really around, well, first the jobs report, but in particular just last night, the FOMC minutes. Snuck in there was the R word, and we sort of now come towards US earnings season worrying about earnings contractions, again, possibly technical recessions in different parts of the world. I mean, these sorts of rumblings, how do you interpret them?
We've been talking about the R word for so long, Kyle, I have to say. It is so dull to be talking about this. I feel like Gregory Peck standing on the beach in Melbourne, waiting for the radiation cloud to come down on the beach in the 50s movie. It's just, we're going to have a recession one day. It's inevitable. But when is the big question? The US unemployment rate is 3.5%. The unemployment rate here is 3.5%. We're not seeing that many signs of a looming recession either here or in the US. We may get a tiny weeny one, but given the Fed has a lot of scope now to cut rates if it really turned into a nasty recession, I think we're just getting too hung up on this whole recession or rates or recession or rates or recession. I mean, come on, we've got US reporting season coming up. That's going to be kind of important for us. I mean, not really going to be able to draw too many parallels with Australian banks looking at the Goldman Sachs results, maybe Bank of America, Wells Fargo, but it's hard to extrapolate what's happening with the US and international tech companies to our little old market here, which is based on mining and banking.
Yeah, you're so true, Henry. It's a really case of, are we there yet? Are we there yet? And it does seem to be ridiculously drawn out. And, there will be winners and there will be losers along the way. So someone was chatting to me the other day. I don't know if this is in your universe, so I'm trying to keep it smaller rather than asking about commercial property. Nudge, nudge, wink, wink, which, was anyway.
I've boned up on commercial property since our last conversation, Danielle, and I am now an absolute expert on commercial property.
Fantastic. No, but somebody was chatting to Dick Adata about me. Is that one in your universe?
No, not really.
Oh, okay. Well, we'll leave that one and forget about that.
I've looked at it before. I'll have to put that aside with the commercial property info.
Yeah, of course. Well, just in terms of, I suppose, coming into this sort of US earnings, you did allude to it a little bit, but I mean, can we infer much at all from the corporate profits and the activity that we might see in the United States, especially amongst the banks, to anything locally too? Because I mean, in 3 or 4 weeks' time, we're going to get our own bank results, going to be significant for our market. And there's, some level of concern that some of that, I guess, negativity about the economic outlook might be reflected in what our banks have to say in 3 or 4 weeks' time.
Well, that is true. Obviously, the banking machine still makes $30 billion in cash profits between the 4 banks. They pay extraordinarily high dividends. That's not going to change. There may be some tinkering around the edges. Don't forget as well, we've got a massive refinancing event happening this year. All those fixed rate loans that run off, that we've been talking about, that cliff where people suddenly run into trouble. A lot of people, I think, have been preparing for that cliff. It's not like a Thelma and Louise moment when they just go flying off the cliff willy-nilly. But the banks have got an opportunity here, and there's certainly a very competitive environment out there. We've still got 3.5% unemployment. And while we've got 3.5% unemployment, the bank bad debt provisions are going to be well and truly under control. As long as people have jobs, okay, they're going to feel some stress. They're going to cut back on spending in parts of the economy. But for every for every loser, rather, there are winners. You've got to remember that there is a whole bunch of people that don't have mortgages, that actually rely on interest rates being higher and bank deposit rates, and have done very well out of the fact that the RBA is raising rates. So it's not a sort of a catch-all and kills the economy kind of situation. There will be winners. I think the banks will be solid. It's very politically hard for the banks, as always, to crow and go, aren't we geniuses, especially given the backdrop that's happened in the US with that kind of mini turmoil that we've seen with SVB and First Republic. But, the banks have a very tight rope sort of politically to walk. We've got the May budget as well. There's nothing a government likes better than bashing the banks if they make too much money. They want them to be strong, but they don't want to make too much money. Obscene profits, 30 billion, is that obscene? I don't know. But they'll be solid, they'll be unremarkable, I suspect. They'll talk about the economic deterioration, they'll talk about the refinancing, they'll talk about bad debts. They won't probably be very optimistic about the future. They'll play down things, but they'll still pay dirty, great big dividends, fully franked, and investors will reward them for that.
Yeah, it's interesting. There's been quite a lot of competition in the mortgage market to pick up that refinancing, as you're talking about. I mean, it's $400 billion odd dollars. I think it could be more than that. So it will be interesting to see how the bank margins do. In fact, I was reading today about the upgrade on Westpac and Bendigo Bank, that they're actually expecting the results, the NIM, the net interest margin, to hold up a lot more, and the results actually to be not as bad as everybody expects. So we'll definitely have to see.
I guess one of the things that banks do rely on substantially is the fact that we are lazy. And that we don't shop around, and we don't switch and swap. I had an email the other day from one of our members who was talking about their bank when they came to refinancing their loans on their investment properties. Their bank basically gave them such a huge rate that there was no way they were going to accept it. So they shopped elsewhere, and being good deposits and credit holders with the bank or with another bank, they got a really good deal with another bank. So off they went, and they do this every 2 or 3 years, and they save a fortune. And the banks rely on us being lazy. I mean, how many of us have still got the same bank account that we had when we left school? I know that I have the same bank account, but when I worked at Macquarie, and it's a terrible bank account. I just can't be bothered to change it. And I can say I bank with Macquarie.
Yeah, no, it was actually on a competing podcast I was listening to last week, the same dynamic in terms of deposits, that people just don't move them, and the banks just keep deposit rates low because they just don't expect anyone to get off their backside. So
exactly, it's crazy. We're all guilty of this, and what I find really annoying and what really gets me upset is when you're a loyal customer, you don't get rewarded for that loyalty. It's the new customers that they try and entice with new deals. It must cost them a fortune to get new customers, and they forget about the loyal customers and rewarding them. It's crackers, and everybody does it.
Yeah, it's the same too with your phones, your telco contracts, and also with insurance. And I've actually made a point recently of being far more proactive, of ringing around and actually doing that work, because otherwise they just leave you on the higher the higher price.
Yeah.
And
we're just lazy. That's the problem. And that's why banks make $30 billion a year.
It's a good business model, profiting off people's laziness. It's a universal recipe to success. But I just wanted to ask one more question, because one thing we haven't discussed yet was we had some data out of China today, and didn't really shake the earth by any means, but it still indicates that maybe things are a little bit sluggish in China's economy. Disappointing perhaps, especially from an investor's point of view if you're exposed to it. I do know you sort of specialise in sort of your more small cap portfolio, which I would imagine has some level of sensitivity to the China story. I mean, how are you reading things over there at the moment, both from just what you're seeing from the fundamentals, but how it's affecting our markets?
This is another commercial property question, isn't it?
I've done it again.
As far as China goes, it's the recovery is happening. It's slower than anticipated, I have to say. It does appear that it's slower than anticipated, but the numbers today weren't too bad. The export numbers were pretty good, so something's happening somewhere in the world, that's for sure. China has lots of levers it can pull, of course, and we could see maybe some acceleration in the pace of the economic growth in China, and that is probably one of the only bright points in the global economy, according to some economists at the moment, is China. So, we're still seeing commodity prices relatively high. I read an article today about the summer coming and power outages in China, and how they had to look for more coal supplies, and they're even looking at more nuclear. So that's going to help us as well in Australia. And the other great thing, of course, that's going to help us here in Australia is this thawing of relations. Barley one day, maybe wine the next, in terms of the World Trade Organization and those tariffs that the Chinese put on us. So maybe that is going to help us as well in terms of our biggest customer is starting to play nice with us.
I've got one more, and I know I'm going to be on the money with this one, and I do want your opinion on it, because it's the Morgan Stanley broken notes on on Pilbara yesterday. Did you have a view, or maybe a bit of an update on the space? Because of course some of that steam's come out of the market after the big Liontown Resources bid.
Well, some of the steam has come out of the market. I still think Pilbara, when you compare what Albemarle is bidding for Liontown, and there's 130 odd million shares still short in Liontown. They're buying them back very slowly. It's now sort of 10% above the bid price pretty much. But Pilbara does to me look kind of cheap compared to Liontown. But it is a long-term story. We haven't heard a lot from Pilbara recently. They're just about to get slammed to some extent with the cyclone that's about to hit the WA coast. So that's going to be interesting to see what the fallout of that is. But to me, I still think Pilbara looks a standout for some sort of corporate play, big fat balance sheet, paying a dividend for the first time, good management, good product, expansion plans, and it's, compared to Liontown, which is still a glint in somebody's eye. Okay, they have started construction, but it does look pretty cheap. If you're going to pay $6 billion for Liontown, you'd be better off paying $10 billion for Pilbara, surely.
Henry, we'll leave it there before I mess it up. Really appreciate your time today. Henry Jennings from Marcus Today.
Thanks, mate. Thanks, Danielle.
Bye.
Okay, well, let's cruise through what's on overnight. And, actually, I was going to put UK GDP on here because I think it is reasonably relevant just for the macro watchers out there, because, there's still the expectation that the Bank of England could push forward with its rate hikes, but it came out actually at 4 o'clock, so I just wanted to check that very quickly for those who might be interested in that. And it was actually flat, came at 0%. The expectation was for an expansion of 0.1%, so somewhat soft there. But tonight, not as significant as last night. We did have that inflation figure out of the States, which was maybe slightly softer than expected, but PPI tonight.
Which is important.
Which is very important.
Producer prices is really, really important because they're all the, input costs and things. So I do think that is important. And it'll be interesting to see jobless claims as well. Yeah,
that's often the first worm to turn, so to speak, when it comes to economic activity. So we'll keep an eye out for that. All right, leaders and laggards now, and let's see what was at the top of the pops today. Corporate travel. That was the star performer. We went through that, but there was a slight tilt again to some areas of the resource space. Otherwise, Lendlease, Ingenia, Netwealth, I didn't see any stories behind it necessarily. No stories. I just think Lendlease has been quite a laggard, so maybe there's some bottom fishing going on in there. There are also some other property, more REITs that were quite well bid today. So I don't know how that corresponds to, potentially, another rate rise, but nevertheless some bottom fishing in those stocks. Yeah, and just on this topic of the REITs, it was up 0.35%, which, typically you'd get a lift in expectations for rate hikes. That might be an area of the market you would typically see underperform, but like you said, they'd already been beaten up. So maybe, like you alluded to, a bit of bottom fishing there. But there was a lot of strength coming through the energy plays. IT names were rather strong as well. And corporate travel, we just can't go past. It was up 12.4% for the day. Just to recap, it won a $3 billion contract with the UK Home Office. As we said before, the gravy train, you've got to get on that government gravy train. Corporate travel management has managed to hitch its wagon, so to speak, to that. Let's go across the laggards now, and Block. And this was interesting because I didn't see any news whatsoever off Block, but the payments providers last night on Wall Street apparently were sold off. Bitcoin's back below 30,000, so look into that what you will. But the company's still dealing with that short report from Hindenburg Research too. Probably more if the US ones were sold off. It might be something with that R word, dare we say, as one of the reasons. But they've definitely, those buy now pay later companies, or Block. It's got a few headwinds to say the least at the moment, maybe softening in economic activity. Coal's down 3%, just because that stake that Wesfarmers has dropped 2.8%. I'm not aware of any news, particularly with Domino's, which was down about 3.2%, except I think the share price has rallied off the lows from the most recent downgrades we saw. And stocks like Champion Iron Ore had been very, very strong a few days previously, hadn't they? Had a good run up. Yeah, no, if there was ever a time you could say taking profits in a name, Champion Iron was probably it, because it was on the leaders board yesterday.
Correct, yeah.
And Domino's too, not out with any news, but it has rebounded off its lows after getting absolutely smacked down the last time the company reported. Let's peruse very quickly the small caps and the movers and shakers in that space, learn a few names, of course. Rare earth seems to be a little bit of a theme there, but
absolutely
quite naturally too. Just a very resource intensive. We'll look at the laggards in the small caps as well, and it just comes out for every day. Jervois Global, my favourite stock. I just should buy
What are
it
you
for the hell
doing
of
to it, Carl?
I don't know. I must be pumping this thing somehow just by, you know, the Twitter algorithm is picking it up every time we speak. It's throwing this thing
Drone
around.
Shield.
Ah.
Yeah, that's
We've
interesting.
spoken to them before too, actually.
Yes, they're down 7% because I think they recently won a contract, didn't they, over in Ukraine or something? But yeah, so that's off 7%. But Jervois taking the cake, almost down 14% again today.
I can't wait to see what it's doing tomorrow. It's becoming like a sport for me, Danny. Okay, well, we may as well leave that there. And, well, it's been another day. A down day, unfortunately, breaking a streak of 2 days of gains. It has been positive throughout the week, a bit of a pullback off the back of that jobs report, which showed, well, a slightly stronger and more robust labour market than perhaps economists had been expecting in March, down 0.38% for the session. Danny, what do you reckon? We call it a day?
Absolutely.
Cool.
Great day, though.
Great day indeed. All right, well, remember, you can catch up on all the news and views on our website and app. Until tomorrow morning, have a great evening.
The COB is brought to you by eToro. Invest in ASX shares with $0 commission.